Yeah. So according to the latest numbers of the Global Sustainable Investing Alliance, every year almost $4 trillion flow into sustainable investment. So that's more than the SDG funding gap. Now, my question, if that's true, why haven't we solved the problem of this world already? So for me, this clearly shows that we need to have a closer look at the impact of sustainable investments. Let me go to the next slide. So this is exactly what we do in our most recent paper. The paper is titled, Can Sustainable Investing Save the World? Reviewing the Mechanisms of Investor Impact. In the paper, we basically review all the academic literature that deals in some way with the effect investors can have on the real world. So we look at 64 papers, and in this webinar, I would like to present you our key insights. So let me give you a brief overview on the webinar. So our aim is that after this webinar, all of you are able to characterize and compare the impact that you can have with different investment products. First, we will discuss what actually is investor impact. Then we'll have a more detailed look at the mechanisms of investor impact. And in the third part, we'll apply this concept in an interactive way, the game that Erin introduced. Here we'll look at the impact of concrete fund examples. And finally, we briefly wrap up. So before we get started, next slide, a brief disclaimer. In the following, we will discuss investor impact of different funds. These funds were selected to illustrate the mechanism of investor impact. In no way we want to provide advice against or for investing in any of these funds. So, but now over to Julian and the question, what is investor impact?
All right. Thank you, Florian. And let's talk a bit about what is investor impact. And just to note, it was on the slide, if you have questions, please go ahead and use the chat, because we've built in breaks into the webinar where we then want to address those questions. All right. Now, but we go on with something interactive as well. So here was the first poll that you've already briefly seen. Do you think Tesla as a company has a positive impact on the climate, right? Just from the top of your head, give this a moment. And Erin will give you a few moments to answer that.
All right, another 5 seconds.
Yeah.
Most people have voted. All right, I'm gonna launch the poll.
Interesting. So actually 40% think yes, 60% think no, right? So this is obviously something you can debate. And as you see, there is disagreement. The cars are electric. Then the question will be, what is the electricity mix that goes into the cars? But the point here, this is what the company is doing to the world, right? Now, we'll have the second question where we ask, does buying a Tesla share now have a positive impact on the climate? And let's see what your answers are here. Wow, we have very fast voting here.
You guys are quick. All right, another couple seconds and then I'll launch the results. All right, I'll go ahead and launch the results now.
Okay, here we have, oh, this is incredible. Is it exactly the same result? Is that true? Like 41, like, 59? Huh?
Interesting.
Yeah, I'm surprised. Anyway, so here again, we have a majority who thinks no, and actually the same, exactly the same results as on what the company is doing. Now, our review is going to contrast with that just a slight little bit, and but I'll take you through it, right? So the point is here to distinguish in what does the company do already, and what does an investor add to what the company is doing already by, for instance, buying a share. Our point is that it's really important to distinguish between investor impact and company impact. So it's not what you own, it's what you cause. That's what we mean with investor impact. So company impact, we identify as the change in the world caused by company activity. And investor impact is then the change in company impact caused by an investment activity. And I realize now the majority was of the opinion that Tesla actually doesn't have a positive impact on the climate, or maybe a negative or no impact But that's not really what we want to drill down into, even though we realize that's a question that, you know, you could debate, definitely. But for argument's sake, if you will follow me in saying this, that Tesla sells 200,000 cars, and if you look at the life cycle analysis that has been done on these cars, you get varying results. But one example that we pulled out says 30 ton of CO2 equivalent saved per car. You get sort of 6 million tons saved per year. That's what the company does. But now the big question is, what is it that the buying the share does, right? The company is already doing this. What does the investor add, or what does the investor change? Do they sell more cars? Do the cars become more efficient? This is the question that we want to address with investor impact. And the second insight is that there are two ways in which an investor can change what a company is doing already. And that is, one, you can grow green companies, or you can change brown companies. So on the one hand, you can enable growth. If a company is already doing something very positive, let's imagine a Tesla that's just perfect, you know, without any of the negative things, right? Then if you can enable this company to grow, sell more cars, you have an investor impact. You changed something. Or the other option is to promote improvement, even when the company is perhaps doing something negative at the moment. So let's take Tesla again here. Apparently, quite a few of our listeners think the company is not having a good impact on the climate. I'm sure there's something the company could change so that it would be true. So that's another option you have. You don't need to, you know, they don't need to sell more cars, but maybe different cars or cars produced in a different way. But fundamentally, these are the two ways that you have. You can enable growth and you can promote improvement. And in both of these ways, you will have investor impact in the sense that you change the company impact that the company is having before you come in. Okay. We have now a few questions, perhaps. And Erin, why don't you select a few questions for us?
All right, great. Yeah, we already have a few that have come in. One of them is, when you do the CO2 calculation in the Tesla case, do you just look at the car or also at the supply chain?
In the example that we gave, we just looked at the car and then the life cycle analysis of the car. Even though the life cycle analysis, it includes usually the raw materials that are needed to produce it, and also the afterlife of the battery and so on. So I realize it's a controversial example, and I'm not going to argue that it is a positive company. We just use it as an example to show that there's a company impact, and then as an investor, you should think about what can you change.
All right, and we have one other question in the Q&A, and this goes back to the first point that you were bringing up in terms of sustainable investments and the sum in sustainable investments. And the question is, how are the investments that make up this $4 trillion sum qualified as sustainable investments? Is it a certain ESG score threshold?
Maybe I can answer that. No, it's not. It's self-reported by the asset managers and banks that take part in this study, as I understand it. So, I mean, different asset managers and banks may have a different understanding of what sustainable investing is. But I have to say the Global Sustainable Investing Alliance, they provide clear definitions in the framework how things should get reported. I would say it's fair to say that this 4 trillion inflow per year is basically everything that's marketed in some way as a sustainable investment.
Okay, thank you. We have some more questions coming in, but why don't we go ahead and move on to the next section first, and then we'll see what we have time for later in the webinar.
Yeah, I would agree to that. I'd love to answer all questions, but we have also material prepared that we want to get through before everyone needs to go the next meeting, right? Florian, I think it's your turn, isn't it?
Okay, good. So Julian gave you a nice introduction of what investor impact is. So now let's go a bit deeper and discuss how investors can have impact, and actually what's the mechanisms how investors can impact. So on the next slide, you see an overview. Here we follow basically the classification of the impact management project and differentiate between 4 mechanisms of investor impact. The first 2 mechanisms aim at enabling growth. The other 2 mechanisms aim at promoting improvement. So I give you a brief overview and then we go more detailed in all of these 4 mechanisms. So first, investors can grow new or undersupplied capital market. The idea here is that allocating capital to impactful companies whose growth is limited by an access to financing. Second, investors can provide flexible capital. This again is about allocating capital, but to companies that really require flexible financing conditions to grow. Third, investors can engage actively. So investors can encourage management to improve as an active owner. For example, by entering in a dialogue with investee companies or by doing voting at general assemblies. Finally, investors can signal that impact matters. This is about sending signals to the entire market, not necessarily only the companies you're invested in. You can do so by positive and negative screening. So for all of these 4 mechanisms, we look at 3 questions in the following. First of all, what is the level of empirical evidence we have for the effectiveness of the mechanism? Second, what are the requirements to actually have impact with the mechanisms? And what are the limitations of a mechanism? So let's go to the first mechanism. So the first mechanism, as said, is growing new and undersupplied capital markets. So investors can have impact by allocating capital to impactful companies whose growth is limited by access to financing. This mechanism is all about the additionality of capital allocation. So the question whether a company grows because of an investment or whether a company would receive enough funding from other investors anyhow. So we found clear empirical support that investors can enable growth under the right set of circumstances. First, obviously, companies need to have a positive impact. And that relates to the question we had before. There's a whole science on how to assess company impact. But this question on company impact and how to assess, that's beyond the scope of this webinar. We're more focused on investor impact. So second requirement is that companies' growth needs to be limited by external financing conditions. And from a large body of literature on financial frictions, we know that this is more likely to be the case in the following cases. So first of all, for young and small companies, then for companies that operate in immature financial markets, for example, in developing or emerging countries, or for companies with a large share of intangible assets. So there is one important limitation to this mechanism. An impact on growth is unlikely for large and established companies in mature financial markets. So, like for example, Tesla, the example we discussed before. Such companies usually have plenty of access to financing solutions. So if they have a business case, if they have the growth plan, they want to get financed, they can easily get financed by large financing institutions. So let's move to the next mechanism. So the second mechanism is providing flexible capital. This is, so to say, the concessionary counter of the first mechanism. So some companies may require flexible financing conditions to deliver their impact. For example, if their business model is about solving social or environmental externalities that nobody is willing to pay yet. So flexible financing condition can include different things. First of all, accepting below market return may be very obvious, but it can also mean accepting longer terms before exiting a company or taking subordinate debt or equity positions. Again, the requirements here are that companies do have a positive impact with all the associated challenges of measuring that. And the second requirement, again, is that the growth is actually limited by a lack of flexible capital. The main limitation here, obviously, is that investors who want to have an impact with these mechanisms need to be willing to take a cut in their return. So let's look at an example of how investors can spur growth. So let's look at Root Capital financing the Musasa Coffee Cooperative in Rwanda. Many coffee farmers in sub-Saharan Africa sell their harvest to local middlemen for a very tiny margin. This often keeps them locked up in extreme poverty. Farmers could make a much higher margin by directly selling to global specialty coffee markets. However, these farmers often have no access to financial markets to lend the required upfront capital they need to access these markets. And this is where root capital comes in. They provide loan to local coffee cooperatives in areas where financial markets are literally non-existing. And this again enables the farmers to access global coffee markets and have a much higher share of the value add of their coffee, which has a substantial positive impact on the life of coffee farmers. So I think this is a great example to show that capital allocation has the strongest impact where financial markets are least efficient. Good, let's move on to mechanisms that with improving companies. So over to Julian again.
Thank you, Florian. And yes, so the other route, of course, as we introduced, is to promote improvement. So here, and you've noticed that the mechanisms that Florian has described, they are geared towards small companies that are struggling to raise finances to grow, right? And obviously, most portfolios, the biggest part is not in this type of companies. It is in publicly listed companies and so on. And as Florian said, it is really hard as an investor to help them grow because they have good access to financing already. But what you can do is promote improvement. And here are two mechanisms how you can do that. The first one is engagement, active engagement. As Florian mentioned, it means that you enter into a dialogue with management and you request certain changes, you plant ideas. And here we have fairly strong evidence that engagement by investors leads to changes at companies. There's several studies showing that empirically. We also know that there are certain requirements that benefit effectiveness. So first of all, it helps when investors focus on practices that have substantial company impact. So they make a sort of meaningful change, but also low implementation costs. The studies show that as soon as you start requesting things that are expensive for the company to implement or very complicated or require a change of the business model, the success rate of these types of engagements is actually very low. So it's more effective on sort of the low-hanging fruit. We also see that engagement resources and skills matter. So for instance, the studies show that it matters who is engaging and what sort of reputation this institution or person has. The limitations are of engagement that it can be really slow moving. You may have to wait 1, 2, 3 years to see sort of the fruits of your labor. And that, you know, that can be frustrating. And also it is unlikely to transform industries. And that has to do, of course, with sort of the focus on low-hanging fruits. But let me give you an example here. So this is Hermes engaging Sinopec, a Chinese oil company, on climate change. They focused on this problem of methane leakage. Methane, as you may know, is a potent greenhouse gas. And Hermes initiated a dialogue with this management, and several years later, they launched a methane reduction program that, according to their calculations, saves about 440 million tons of CO2 equivalents per year, right? So you see several things here. First, it is focused on a very concrete practice, and that is, I don't know what is the cost of implementing that, but it seems to me that this is not prohibitive for an oil company. It's like a more operational improvement, well within, you know, other investments that they take there. It took a long time to come about. And then there's kind of these two sides of the coin, right? Sinopec is still an oil company, and the fuel that they sell leads to many-fold more emissions than what they're saving here. So you cannot say you've transformed the industry, but still, on the other hand, 440 million tons of CO2 equivalents, that is actually quite a lot. And the the important point is this is something that investors have achieved. So there's evidence that as an investor, this is the type of change that you can achieve. Right. Now, finally, mechanism 4, signal that impact matters. This is in many ways perhaps the most complicated or controversial mechanism. What we find is there is theoretical support. There are theoretical models that kind of say when there are a lot of green investors that focus their investments in green companies, there arises an incentive for the brown companies to improve, sort of to become also green. The problem is that this is not empirically confirmed, that this is actually happening. It's not easy to study, but more than that, it's theoretically predicted, but we don't know how important it is in the real world. Like, does it really matter? And does it really drive change? This is something that's uncertain at this point, as far as we can see. We do still know, however, a couple of requirements that are derived from the theoretical papers. And the first one is the same as for engagement. So the focus should ideally be on practices with low implementation costs. Why? These kind of shifts in the market, they will create incentives to change, monetary incentives. And the assumption in the theory is that as soon as the incentive is greater than the cost of implementing the change, companies will do it. So if the costs are low and we don't know how big the incentive is, it's just more likely that it's going to happen. And second, many investors implementing the identical screen. That's a very clear prediction. It is required that a big share of the market is doing this. And the focus is on identical screen, so really, making the same distinction between brown and green, not just a lot of sustainable investing as perhaps in that figure that was reported before, because that means, when you drill down, it means effectively many different things. Limitations of this mechanism are, it is unlikely to work for industry exclusion, even though that's a popular measure, but the reasoning is that for a tobacco company, there's no incentive big enough to sort of improve out of being a tobacco company, right? So it doesn't work in this case. And there are studies that look at what the financing of tobacco companies then does, and it shows they continue to find financing so far and probably for a long time. So we don't think this is a very effective thing on the industry level. It should be conduct-based screening on things that companies can actually change. And the second problem is an inconsistent measurement of ESG issues. So that goes with many investors implementing the identical screen. So just the dispersion of measures also leads to a dispersion of the effect. And that we know that can be an issue. Okay, I'm not going to provide another example here because we have cards to which we want to apply all this later, but we will have some time for questions, and I hope there are some. Erin, how does it look like?
It looks like there are quite a few questions. And I'm hoping that some of the questions actually were answered during this past part on the different mechanisms. But if you still have a question, the same question after this, then please ask us again. But one question that came in was, do you think that too many impact investors focus on supporting green companies with additional and flexible capital rather than engaging with bad brown companies to change them? And where, as an investor, where do I have the best chance of making an impact? Doing a bit of both, or should I favor one mechanism over another?
I think that's a great question. And what I find interesting is if you look at growing green companies, if you look at asset classes, that's mainly alternative investments. And if, as Julian mentioned, changing brown companies, you may have the largest impact in public equity and debt. So that's kind of two parts of your portfolio. So there's no reason why you couldn't do both. So I think my answer would be kind of an effective combination, maybe for your more liquid assets, public equity debt focus on promoting change and improvement, but then carve out a part of your money to do illiquid assets like alternative investments in small companies, and really try to grow some really impactful small companies. I think it's a strong combination.
Yeah, I would add to that I wouldn't say too many investors are focusing on growing green companies. I actually think a lot more are needed. But there can be a case, of course, where too many just focus on a very small set of popular entrepreneurs, where then it's really important in this space that you spread out and go where not so many others are right now to really have your impact. I think that is important. And then I also believe it's maybe more fun to to support entrepreneurs and be like really identify with what they do and their great business model, than to fight for these tiny improvements in large corporations. But I think it's really important not to discount this, because there's a lot of change to be had in this way, and we just should, as Florian says, play both channels.
And maybe another point to add, I showed these numbers of 4 trillion, and some people question, oh, what is that? And if you look what's inside, kind of product-wise, I think growing green companies is only a very tiny share kind of products that actually target at green growth and small companies. And only also relatively small fraction really fulfills the criteria to improve companies. Many of these are products that have some ESG criteria or in some way integrate ESG aspects, but without kind of mechanisms that are empirically supported to have an impact. So I think for both areas, there's a lot of potential to grow.
All right, there are still quite a few questions coming in case you guys don't see that a lot of these questions are coming to us, just the panelists. And there are a lot of great questions, but we're going to go ahead and do the game, and then we'll see what we have time to answer at the end live, and then the rest we will answer in our Medium post or directly. So
okay, sounds good.
Perfect. Okay, good. Then get a little bit even more interactive. So what we will show now derives from actual physical card game we do in our workshop when we can do workshop physically. So we applied this, adjusted this for an online audience. Let's see how it goes. So we will now show you several real funds. And we want to know what you think about 3 questions. So first, do the companies the fund invests in have a positive company impact? So do they help to make the world a better place? And then second, does the fund have an investor impact? So does the fund actually increase company impact in some way? And if you think yes, it does, how does it increase company impact? Does it enable growth or does it promote improvement? So let's go to the first example. This is the Blue Horizon Venture Capital Fund. Please take a few seconds to read the description of the fund. And then think about, oh, the poll already popped up, think about company impact, investor impact, and the type of impact you think it has. So let's wait for a couple of seconds. You may know some of the companies. Beyond Meat, Impossible Foods especially have been discussed heavily, especially in the US, also arriving in Europe. So answers are coming in and coming in. Yeah, a lot of activity here, great. Good, okay, Erin. Should we share the results? Amazing. Perfect. So you see, I mean, most people think this is an example of high investor impact and high company impact and enabling growth. So we would, I think, basically completely agree to this judgment. So I think meat production is certainly a major driver of climate change, and startups that like Beyond Meat could have a major impact in mitigating emissions here. I think investing in early stage startups clearly is a place where you can make a difference as an investor with your capital. But I think it's also important to see the limitation. And I mean, there may be startups that are actually flooded with capital. And I think for Blue Horizon, it's interesting to think a few years ago, artificial meat was really a niche issue and financing was really important. But I hear nowadays that artificial meat startups are really investor darlings. So they really don't have that much trouble in raising capital. We can also compare that to the example before, Julian, if you go to the next slide, to root capital. So venture capital is an inefficient market, but it's an existing market. Think about root capital that provides loans in places where there's literally no market, they even have a higher additionality. Good, let's move to the next example.
Well, you still wanted to mention, even though that's clear to everyone, that this is a growth impact, of course, like the
definitively, yeah.
Yes. Okay, great. I'm psyched about the agreement that we had in this poll. And the next fund, let's see how it looks there. This is same poll, same questions, and I'll give you time to read the description here. And I'm very curious how you would classify this fund.
Interesting to see the poll developing. That's cool.
Yeah, it's so scary.
Scary.
People are very active. That's in giving their...
Oh, there's a question. We don't know whether they engage. So as far as I know, well, at least they don't say that they do. I know BlackRock is doing engagement in various ways. Florian, maybe you know more. But
no, definitely on the fund level, this fund is not engaging.
Okay, thank you.
They don't have an engagement policy. They just invest in renewable energy companies.
Yeah, it's kind of a thematic fund, and they focus on these renewable energy companies.
Good. We seem to have a picture here, huh?
Yeah, I think I'm going to close the poll in 2 seconds. All right, closing the poll. I'm going to share the results.
Less agreement. Amazing.
Okay, so this is a little bit more controversial. Company impact, most people think it's high. I would tend to agree. I mean, of course, it's always important to look at the details, but these are companies that were pioneers in renewable energy technologies and have gotten big and are selling a lot of these things. Investor impact, most people think it's low. And there we tend to agree. Why? These are by now publicly listed companies with established banking and financing relationships. Most of them have issued bonds before. So they are into the game of raising capital, and your capital that comes in through this fund is, has, if at all, has a really minor impact that at least we are not sure about. So we would classify it as kind of low investor impact, even though these companies no doubt have a sort of reasonable company impact. And the type, of course, is in this case, well, it has no, pardon me, I'm already at the next fund. It has no investor impact type as well. But I'm glad how this came out. Let's see how the next one fares. Florian, it's over to you.
Good. So over to the next fund. So this is the Hermes SDG Engagement Equity Fund. So it's a fund with a strong focus on shareholder engagement. And what Hermes says they do is actually they target companies who have a strong potential for improvement by engagement. So again, let's have a few seconds to read through the description and then have a poll. Maybe what I can say, the holdings are fairly unknown. I'm CD, Tectonic, Alliant. So it's large. It's rather smaller companies, less well known. Again, yeah, interesting how things develop. So let's see what people think.
All right, I'll give another 15 seconds or so for the poll. Let the votes come in. All right, I'm going to launch the results now.
Okay, that's an interesting picture. So I think most people agree that this is a fund with a rather high investment impact, although not all people agree. And most people say this is about promoting improvement. So that's also what I would say I would classify the fund. What I find interesting, there's quite some disagreement on company impact. Exactly 50% thinks it has high and low, high impact, and some things it's low company impact. Actually, Julian, if you go to the next slide, I did some research and looked at the ESG ratings of the company in the fund. And most of the company in this fund actually have a rather low ESG rating. So that they're faring pretty bad in ESG ratings. And I guess you may have seen the Morningstar Globe rating. If you look at the Morningstar Globe rating for this fund, it looks terrible. It's the worst category you can get. So I think that's an interesting example, because I think this is a good case how you can have impact in liquid securities. But I think you have to realize that if you do engagement, it may be more promising to focus on companies that have a lot of room to improve, if you want to improve them, than on companies that are already doing great in terms of sustainability. So Julian, if you go to the next slide.
Yes. Here's my.
Yeah, I have this nice arrow. So for improvement, it's about kind of not the company impact companies are having at the moment when you invest, but more kind of the way they have ahead of them. So can you encourage them and cause them to improve and to change? Then I think you saw the example before of Hermes engaging Sinopec. I think many would agree that Sinopec definitively is a very brown company. Still, I think that there was a substantial impact that Hermes had there. And I think this is our example definitely for a change improvement product. So let's have a last product, even more controversial maybe. So
all right, let's see. So this is mine again. Same question to you. This is Vanguard ESG US stock ETF. Small to large cap public equity, and they do some excluding of sin and fossil stocks and screening for ESG criteria. And you see the biggest holdings are Apple, JP Morgan Chase, and Procter & Gamble.
So answers are coming in a bit slower here. I think people are thinking a bit more.
Maybe, hopefully, people are thinking, but also the early exit polls paint a very clear picture. But we'll give those that thought a bit longer also a chance to weigh in.
Yeah, I think another couple seconds, and then I'll close the polls.
Oh, yeah, somebody is making a good comment. Looking at the empty space on the chart, someone has a point. Thank you, John. Fair point.
The good old 2x2.
Yeah. Okay, well, so no big surprise. We classify the fund kind of here towards the low end on both sides. I mean, we wouldn't say that the companies, the large holdings here are absolutely terrible. Maybe their company impact is somewhat low medium. But and the investor impact, due to the reasons that we've explained, right? These are very big companies. They don't depend on being included in this particular fund, and also because the exclusions are based mostly on the industry level. Even though that's something perfectly legitimate to do, maybe for ethical reasons, we just don't see a lot of evidence so far that this actually hinders the business of sin and fossil stocks. Okay, right. Also, somebody agrees, Rakesh, one of the worst funds we looked at. Okay, thank you for the comment. We didn't want to word it quite as strongly, but we sort of, I guess we agree. Okay, with that,
Maybe,
I think we definitely should go to a couple of questions.
maybe one point to add. I think what's interesting is, for example, they also do ESG and conduct-based screening, kind of. So, and that points out to one of the big open question here in the research. So, I mean, if enough funds screen against certain ESG criteria, does this have an impact or not? Or the UN Global Compacts, many people screen against UN Global Compact. So does this have a negative price impact for companies that actually do not follow the UN Global Compact? So
yeah, this is at the research front, and that's something we'd still like to find out. That's right. Okay, I'm sure you have some questions for us, and also I'm sensitive to time. So I guess we have like what? Time for 2 questions, maybe?
Yeah, we have time for a couple questions. Let's see what we get through. There's a lot of questions that came in, so thank you for your questions. One of these questions is about engagement. And it says, is there empirical evidence that real world improvements are caused by engagement, and how is that measured?
Yeah, I think that's a really good question. I mean, Julian already mentioned success goes up with low implementation costs. So exactly this question is one of our current research questions. We just had a master student looking at a big data set of a asset manager. And what she found out is actually success rate decreases with real world impact. So, I mean, it may be easy to cause companies to publish some reports or improve some numbers and do some minor, more cosmetical changes, but it may be harder to cause far-reaching, really impactful changes. But nevertheless, there are really nice examples where this happened. For example, with BP, the big oil company shareholders pressed the company and the board of directors to link CO pay to renewable and CO2 targets. So I think, but again, that's an ongoing field of research. How can investors cause real world impact with engagement effectively?
All right. Another question, it kind of goes back to what we were talking about before in green versus brown companies. And it's specifically about investment volume. So the question was, do you think that, so this kind of deciding to grow a company or to shift a brown company to a green direction, do you think that depends on your investment volume? Like if you have a lot of shares, you can try to change a brown company, but if you have a small share, then you would rather go with like a green company?
Yeah, I mean, obviously how you build your strategy around sort of our insights depends on where you're starting from. If this is you as an individual, or is it a big institution, and what your how your investment strategy looks besides having an impact, right? That matters, and whether you're big or small. To the question concretely, definitely size helps. I think if you engage, or also sort of in terms of people just simply pay attention to what you do if you are a big player, right? Sort of if you're a BlackRock or the Norwegian government fund. I mean, there's an added relevance to whatever they do simply because of size. Some of the people doing engagement professionally have told me that it's often not even clear to the company how many assets and shares they represent. So it appears not to be sort of a dominant driver of whether you are successful with your engagement. But then again, I think when it comes to votes, obviously you have more votes if you have more shares. So there, I think it does matter.
And maybe briefly to add, I think there's 2 ways you can engage. You can really become an activist investor and pressure a company directly. But engagement also works as an overlay service that many professional engagement companies offer. So you can, even if you have relatively small portfolio, I mean, if you manage to get your bank to get an overlay service and also do voting on your behalf, I mean, there is no reason why also with a small portfolio you can pressure your banks and asset managers to vote all your shares.
Yeah, I would agree. That's a good point. Right. I think, Erin, what do you think? We should move on.
Yeah, we've got to wrap it up just so you guys can get to your next meetings. So Thank you for your questions again. And again, we'll get to them in the Medium post or
I see there's many more cool questions.
Yeah. Thank you really for your participation in the polls as well. I mean, this is the first time we've done anything like it. And even though I can't see your faces, just seeing you click kind of made me happy. And so thanks for your participation.
Yeah, it was really cool. So we're going to wrap up with a few key takeaways. If you guys want to write in like what you're taking away from this webinar in the chat function, you can also make it public to everybody by choosing to all panelists and attendees in the chat. Then everybody can see your answer. And then Florian and Julian will provide you with their key takeaways.
Right. We still have some takeaways. So, Florian.
Good. I mean, as Julian already mentioned, I mean, research on investor impact is nowhere near finished. There's a lot of work to do. But from what we know so far, we have assembled some key recommendations for investors how to maximize investor impact. I mean, first, enable impactful growth with alternative investments. Allocate your capital, part of your capital, to young impactful companies that struggle for funding as much as your risk tolerance allows. I think that's an important point. It can be limited, but I think that's a way shift to impactful small companies. Encourage improvement across your portfolio. Again, we had this discussion. For all the rest, especially liquid assets, do voting and engagement. And if you apply screens, both for equity and debt, focus on broadly supported ESG practices that can be implemented at reasonable cost. Then third, on a bit broader perspective, also support systemic change. I mean, be vocal about your investment decisions. It may not have a direct impact, but it may have an influence on the public discourse, an important topic, or kind of management culture and all kinds of more fuzzy things, but maybe not less important things. Also emphasize need for political change. I mean, especially we talked about industry exclusion. This may not have a direct impact, but it may help to kind of dismantle the social license of harmful industries and support further research. I mean, there's clearly a need for more evidence and especially specific guidance on how to have investor impact. We're just at the beginning, I would say. So over to Julian for some more points on how to go deeper.
Yeah. So if you want to go deeper, we want to sort of acknowledge that we're not the only ones doing this, and there's a couple of really important initiatives out there with whom we also in touch with. So the Impact Management Project does really good work in building consensus and classifying things. They call what we call investor impact, they call investor contribution. But I think most of the things that we say are at least consistent with what they say. And we would kind of recommend this resource. The IFC has operating principles for impact management, which are also influential and important. And the CSP, the Corporate Center for Sustainable Finance and Private Wealth, where we are based in Zurich, we offer other training opportunities for wealth owners, wealth managers, and policymakers, sort of where we share our insights in other formats and with other focus. All right, but that's, I think, it from our side. We would be happy if you want to perhaps read the paper. Here's one of these fancy QR tags, but you also find the link, of course, or just by Googling our names. And we look forward to continue the discussion with all of you.
Thanks a lot.
All right, yeah, thank you all for your participation. It was really fun. It was the first time that we've tried something that interactive, and I'm really happy personally with the turnout and the level of engagement. So thank you again. If you have any questions or want to discuss any of the topics directly, Florian and Julian have their contact details here. Again, the paper is through that QR code. And this recording will be on our YouTube channel. We'll write a Medium post kind of summarizing it and also answering questions. And we have a next webinar coming up in a week, and that is on impact through funding social movements and activists. and that's with Antonis Schwartz. And he started the Gorilla Foundation, and that's actually just focusing on exactly that, funding social movements and activists. So he'll be joined by Romy Kramer, who's at the Gorilla Foundation. She's running it right now. And also Falco Petzold. So if you want to join that, that's on May 21st at 5 in Zurich time. And you can find the link. We'll send you the link in a follow-up email after this webinar. So yeah, thank you for attending, and really appreciate your attention.
Thanks, it was great to having you here.
Yes, thank you everybody out there, and see you hopefully soon in real life.
That would be great.
That would be great. Thank you guys.